the Saudi voluntary reduction and the stoppage of crude oil loadings at Nigeria's Forcados facility because of a leak risk have reduced OPEC's oil production. The numbers vary depending on the source, but according to a Reuters study, the group produced 840,000 BPD fewer barrels per day in October than in September. And they don't appear to be changing their minds. Oil prices are up and climbing, with Brent reaching an all-time high of $85 per barrel earlier this week and WTI moving closer to $82 per barrel. The results are already clear. How far will they rise before OPEC starts to pull back the cuts is the current question. Will it be able to increase production quickly enough if necessary? The ambitious public expenditure plans that make up the Vision 2030 diversification program in Saudi Arabia require oil at a price of $90 per barrel, according to analysts. But if prices are allowed to increase too much, demand will start to decline, which would have a boomerang effect that neither the Saudis nor their fellow OPEC members want to see. However, while Saudi Arabia has been purposefully reducing output, Nigeria and Angola have been unable to produce as much as their OPEC quota says, suggesting that this may only be the start of a rally. Additionally, production in Libya has once again been affected as the U.S. shale patches surge and production slows. Oil could hit $100 once more before the year is out if all demand forecasts that have been a key factor in this latest surge come to pass. Given news that crude oil stockpiles in various regions of the world are decreasing, that scenario appears especially likely. Prior to the imposition of Western sanctions on Russia, the amount of the world's oil and gasoline inventories had little effect on oil prices internationally, according to J.P. Morgan analysts this week. The cause is the increase in non-US dollar transactions for oil and energy. The degree of actual physical supply of the traded commodities has become a more significant element influencing their prices as a result of that currency diversity. And demand is once again in the traders' focus. The rate of yearly demand increase for 2023 is estimated to be around 2 million barrels per day by both OPEC and the International Energy Agency. According to OPEC, it is 2.4 million BPD. Although it has warned that oil demand growth will decrease significantly over the medium term, the IEA forecasts a 2.2 million BPD increase in demand. The most recent import and inventory data from China, which is often regarded as the country that drives the single largest share of the world's oil consumption, confirm the perception of solid oil demand. Imports are at almost record levels, and the amount of oil in storage is rapidly increasing. This would also offer China influence over prices if they get too high. According to analysts, if prices start to bother Beijing, it will start selling crude from storage in a move that is essentially a replication of President Biden's P.R.O release from last year. How long Saudi Arabia is willing to maintain its voluntary reduction will determine everything. According to the most recent GDP data, its economy slowed down in the second quarter as oil prices fell. The Saudi economy will likely recover now that oil prices are rising, providing Riyadh good reason to keep the output of its oil at a maximum. Meanwhile, according to data cited by Bloomberg, Russia is conducting record-breaking oil drilling. The first half of the year had a 6.6% increase in new production well drilling above schedule and an 8.6% increase over the first half of 2022. This indicates the possibility of more supply, which would assist to restrain prices in the same way that record Russian oil deliveries to China restrained them earlier this year. But with Saudi Arabia and Russia solidly aligned, this supply may easily continue to be available for as long as the two OPEC Plus leaders see appropriate. The price of oil has been crazy this week. Benchmarks initially rose substantially in response to reports of the largest U.S. inventory drop in years, but then quickly fell when Fitch lowered the United States credit rating from AAA to AA+. Just one day later, prices began to rise once more after Saudi Arabia extended its voluntary production cuts of 1 million barrels per day until December, which was pretty much what everyone expected. Analysts predict that the surge won't endure, but it's unclear where prices will go from here. The majority of analysts surveyed lately by the Wall Street Journal appear to agree with that conclusion. According to the survey, the average price of Brent crude for the current quarter should be $87 a barrel, and it should stay at this level until the second quarter of 2024. Analysts predict that the price of West Texas Intermediate will be $83 per barrel this quarter and into the first half of 2024. Even with OPEC Plus's ongoing reduction and the recovering Chinese economy, they do not expect prices to rise significantly since China is recovering from the pandemic more slowly than anticipated and, intriguingly, because Saudi Arabia's voluntary production cuts have increased its spare production capacity. Although China's recovery has been less even than economists appear to have anticipated, it is still recovering, and the country's oil demand is at an all-time high. However, it might have peaked earlier in the year, which would indicate slower growth over the following 5 months and perhaps longer. Spare production capacity was a major worry when oil demand started to increase following the first round of lockdowns a few years ago. The worry was that the global oil sector didn't have enough spare capacity to handle a projected spike in demand due of underinvestment. This warning has not yet needed to be put to the test, but Saudi Arabia is aiming to increase its reserve capacity in the medium term. But even as it achieves that, production is being constrained. The argument for more spare capacity is somewhat moot because by limiting output, it is reducing the amount of oil that is immediately available to purchasers. Saudi Arabia may increase its overall production capacity to 13 million barrels per day as it plans to, but if it is only producing 9 million barrels per day to maintain prices above $80, the extent of its spare capacity is of very little significance for short-term and even long-term price movements. However, there is one additional element that is keeping prices in check: the uptick in offshore drilling. As businesses increase offshore exploration, Wood Mackenzie stated last month that deepwater rig utilization is rising. In a recent note that was cited by the Wall Street Journal, Goldman Sachs also mentioned this recovery. The bank claimed that the potential increase in prices is constrained by the recent sharp increase in OPEC's spare capacity, the resumption of growth in offshore international projects, and the falling U.S. oil production costs. It's important to keep in mind that as oil production costs decrease in the United States, production growth is also slowing down, which should help prices rise. Shale oil production is expected to fall this month after peaking in July, according to a recent EIA forecast. The Permian, currently the most producing shale area, will lead the August decrease to 9.4 million BPD. Saudi Arabia has hinted that it may extend or deepen the cuts in the meantime. To keep prices at levels that are more in line with its government spending objectives, Saudi Arabia seems to have reverted to its old whatever-it-takes stance. Additionally, there isn't much another producer can do to immediately reverse the impact of those cutbacks. The economic forecast for the major consumers continues to be the key price drag factor. The threat of a U.S. recession had previously controlled traders, but more lately, the outlook has improved, which has helped prices rise. Then came the Fitch rating, which shocked the markets despite the Treasury Secretary Janet Yellen's claims that it was entirely unwarranted and Jamie Dimon's remarks that it was ridiculous. In fact, according to Dimon, the U.S. economy is performing so well that even if a recession does occur, it won't be a major issue. Even if we enter a recession, things are still looking up, according to Dimon, who was quoted by CNBC this week. The part with the storm cloud is still there. This impending storm cloud will continue to influence oil prices over the next months, coupled with economic developments in Europe and Asia. The fact that severe recession fears haven't materialized yet, if ever, has helped to temper the surge in oil prices. However, if Saudi Arabia chooses to intensify the cuts and Russia follows suit with its own restraints, the existing forces that are currently holding down oil prices may weaken sufficiently to permit a bigger surge. What are your thoughts on Saudi Arabia and OPEC+? Let me know down below. If you want to continue to learn about business investing and financial education, we have got this video waiting on the screen for you to check out. Don't forget to give this video a like and subscribe for more videos like this. Thank you so much for watching, and I'll see you in the next one.